Hello traders, welcome back to yet another episode of the free Smart Money Concepts course. In this video, we will learn about rejection blocks. Rejection block is a sophisticated concept in SMC methodology that is essential for identifying potential reversal points in the market. This is another important reference point in Smart Money Concepts. So in this episode, we will discuss what rejection blocks are, how to identify and mark these blocks, and we will briefly talk about how to trade these blocks. If you find this series of videos useful, please like the video to show your valuable support, and don't forget to subscribe to our channel because good things are yet to come. Now let's begin our discussion on rejection blocks. A rejection block can either be a sell zone or a buy zone that appears on the chart as long wicks or shadows of candles at the market highs or lows. This block is characterized by a specific candle or a series of candles with long wicks, indicating the strong rejection of a price level or a price zone, typically occurring at key support or resistance zones or near important supply or demand zones. This signifies that the market attempted to break through a price level, but the effort was promptly rejected, thereby hinting at a strong underlying market sentiment contrary to the attempted price move. Such patterns indicate a significant struggle between buyers and sellers, leading to a rejection of the prevailing price trend. This pattern is perceived as a clear indication that the market is not ready to sustain prices beyond that level, be it due to extreme opposition or other institutional factors. So, SMC traders keenly look for rejection blocks as they often precede significant trend reversals or retracements, making them invaluable price areas for predicting future market movements, and also helps in strategizing entry and exit points when it comes to trading from these blocks. Now, let us learn to identify these zones. So, what are the things to look out for? A rejection block is identified on a price chart as a specific pattern where the market strongly rejects a certain price level or zone, indicating a potential shift in the trend. So, the first point is to identify key areas of interest where the price has a good chance of giving a reversal or a retracement after a rejection. These areas can be support or resistance zones, supply or demand zones, or important highs or lows like the daily or weekly highs and lows, etc. The other point to note is that a rejection block is often represented by one or more candlesticks that show a sudden and decisive move towards an area of interest, only to be followed by an equally sharp reversal. This means that a rejection block is formed only after capturing the liquidity from the previous high or low, or equal highs or equal lows. So in price action, this is called a false breakout, and in smart money terms, this is called a liquidity sweep. Now that we know what to look for in the charts, let us learn to mark rejection blocks in the correct manner. Rejection blocks are classified into two types: a bearish rejection block and a bullish rejection block. The logic for constructing a rejection block is very simple. Let's start with a bearish rejection block. A bearish rejection block occurs when the price spikes up but then falls rapidly, indicating a rejection of higher prices, thereby signaling a potential downward movement. So effectively, we are looking for a swing high, that is, we have to find the highest candle. The high and close price of this candle has to be higher than the high and close of the neighboring candles respectively. In that case, the tail or the wick of this highest candle will be our bullish rejection block. Usually, we consider 3 consecutive candles near the highs for the purpose of identifying a rejection. Out of these 3 candles, the middle candle has to be the highest of them all. The color of the candles doesn't really matter, but what matters is that the high of the middle candle should be higher than the neighboring candles, and the close of this candle has to be higher than or equal to the close of the preceding and succeeding candles. Now, once all these conditions are filled, we can mark the entire upper wick of this highest candle using a rectangle. This will be our bearish rejection block. We expect the price to swiftly decline lower after the rejection. Such a move would mean that the price has grabbed the liquidity above the highs and then it strongly moved lower. This would also signal that big players were involved in the price move. Keep in mind that the area near the highest wick or the rejection block still contains a lot of orders waiting to be executed. These include a cluster of buy stop loss orders and buy limit orders. So we expect the price to return back to this rejection block to absorb the buy side liquidity. When price comes back to test the rejection block, we can look to take short trade entries. We can make use of the 0%, 50% and 100% Fibonacci retracement levels to place our sell limit orders. We can set our stop loss above the bearish rejection block. But the issue here is that since buy side liquidity is available above the rejection block, we cannot judge the extent to which the price will extend itself to sweep the liquidity. There are occasions where the wick of the retest candle breaks above the bearish rejection block significantly. So it is always recommended to patiently wait until the liquidity run is over and the price starts to show signs of a retracement or a reversal. Then only we should initiate a short trade. I don't really appreciate the idea of placing limit orders and stop losses way before the price has tested the rejection block. In such scenarios, there are high chances that your stop loss will be taken out. So be a little mindful about it. Now, talking about targets, you can set your take profit level as any of the nearest support areas or demand zones where the price could potentially face a rejection or a pushback. Now, let's talk about bullish rejection blocks. A bullish rejection block is formed when the price quickly drops to a low point but then rebounds sharply, suggesting a rejection of lower prices and a potential upward trend. So effectively, for a bullish rejection block, we are looking for a swing low. That is, we have to find the lowest candle whose low and close prices are lower than the low and close prices of the neighboring candles respectively. In that case, the tail or the wick of this lowest candle will be our bullish rejection block. Usually, we consider a 3-candle pattern in which the middle candle has to be the lowest of them all. The color of these candles are not really significant, but what is important is that the low of the middle candle has to be lower than its neighbors and the close price of the middle candle should be lower than or equal to the candles on the right and left. If these conditions are fulfilled, then we can plot the entire lower tail or wick of this middle candle. This will be our bullish rejection block. So after sweeping the liquidity below the lows and forming a price rejection, we can expect the price to swiftly move higher. This tells us that the big institutions were involved in this move. It is worth mentioning that the area near the lowest wick or the bullish rejection block still contains a lot of retailer orders waiting to be executed. These include a cluster of sell stop loss orders and sell limit orders placed by those reversal traders who bought from the demand zone and those breakout traders waiting to sell below the support area. This is why we can expect the price to return back to this rejection block to absorb the sell side liquidity. So when the price comes back to test the rejection block, we can look to take long trade entries. We can also make use of the 0%, 50% and 100% Fibonacci retracement levels to place our buy limit orders. We can set our stop loss below the bullish rejection block. Here also, the issue is that since sell side liquidity is already available below the rejection block, we cannot really judge the extent to which the price will go deeper to sweep the liquidity. On some occasions, the wick of the retest candle breaks below the bullish rejection block so significantly that even if your analysis was spot on, you would still end up on the losing side due to an early trade entry. So it is always advised to patiently wait until the liquidity below the rejection block is absorbed or waiting for a clear rejection signal, and when the price starts to show sign of a retracement or a reversal, then only we should enter trades in the direction of the rejection. This would mean initiating long trade positions. Now, I don't generally agree with the idea of placing buy limit orders and stop losses way before the price has tested the rejection block. In such scenarios, there are high chances that your stop loss will be taken out. So trade logically and mindfully. Now, when it comes to targets, you can set your take profit level as any of the nearest resistance areas or supply zones where the price could face a rejection or a pushback. So that is all you need to know about rejection blocks. In SMC, rejection blocks stand as a crucial tool in deciphering the market trends and making informed trading decisions. The key to success lies in accurately interpreting these blocks within the broader market context and using them to pinpoint optimal entry and exit points. So make sure to learn the concepts properly, backtest it on multiple charts and on multiple time frames to see if it actually works for you. So if you have come this far, thank you for watching this video. I hope you have found this video informative. If it was useful, please make sure to like and share this video with your friends and fellow traders. Also, don't forget to hit the subscribe button and turn on the notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future episodes. I appreciate your support and I look forward to seeing you in the next episode. Till then, bye.